Welcome to Retirement on the Shore. Thanks for tuning in. We are your hosts, Nate and Bryant, certified financial planners with CFS right here on the Eastern Shore. We specialize in helping people who are approaching retirement or already enjoying it make confident, informed financial decisions. Let's jump in.
All right, welcome to the Retirement on the Shore podcast. I am Nate Canada, and of course, what is the Retirement on the Shore podcast without Bryant Zimmerman? Bryant, how are we?
We're doing well. It's a rainy day, but we're going to make the best of it.
That's right. We are filming this the day after Mother's Day, so thank you to all the mothers out there. I'm sure my mom is going to listen to the first episode here, so thank you to her. So we're just gonna talk about who we are, what we're doing here, and then we're kind of gonna jump into a little bit of a topic, Roth IRAs, and kind of what a Roth is. Just kind of lay the groundwork. It'll kind of be a reoccurring theme, I think. So we'll kind of touch on it now and continue to build on it in future episodes. But first, who are we? I am obviously Nate Canada, and this is Bryant Zimmerman. We are both certified financial planners with comprehensive financial solutions. We are based in Salisbury, Maryland, but we also have an office in Millsboro, Delaware, which Bryant kind of works out of every once in a while here. Both Bryant and I are from the Salisbury area. I'm from Salisbury. Bryant grew up in Mardella. We both went to Salisbury University for college. We were on the financial planning track.
Go goals.
That's right. We were, a couple years apart? You graduated a couple years
about
before me.
2-3 years difference.
Yep.
Yeah.
So we didn't know each other until we started working together here at CFS, but we kind of stuck right along together, and now here we are with a podcast together. So we're looking forward to it. We're gonna, obviously, like I said, jump into some topics today, but just kind of want to lay the groundwork. We're gonna touch on everything financial planning related, mortgage questions, general topics, investment planning, tax planning is a big one. CFS, that's kind of where we feel like we're different from some advisor offices with the tax planning, wouldn't you say?
I would say the reason why we like to get into different topics, financial planning, is it's always changing, especially with the tax law. Yep. There's different rules for IRAs, Roths, different contribution limits. You can contribute, you can't contribute. So there's a lot of topics we'll get into, but I think today Roth is probably a good starting point.
Yep, we feel like starting with Roth is good. Obviously, like I said, we're going to build on it. Roth's going to be a recurring theme, but that kind of ties into the tax planning big time. I mean, it's the whole point of a Roth is to kind of just play the tax game as much as you can. So if you want to start with what a Roth is,
so
lay the groundwork.
I'll jump in. So a Roth IRA, what that is a after-tax contribution into a retirement plan. So what that means is you earn whatever wage you earn, you pay the taxes on that, and then it goes in after you've paid the tax. So once you've paid the tax, it goes into this Roth IRA, and you're able to invest it. And when you retire at 60 or after 59 and a half, you're able to pull from it tax-free. And like Nate was saying about taxes, it's important because if you're 30 or 40 and you pay the tax now and it grows 20 or 30 years, if it was in a regular IRA, it would be into a bigger tax liability. In this Roth, you're allowed to invest it, grow it. You've already paid the tax. Now it's just growing tax-free. So it's a big benefit. So you don't have to worry about when you pull Social Security, if your IRA gets, your Social Security gets taxed. So this is probably, I think, one of the best investments you can get into. But it's situational because there are some people that may retire and be in a low income in retirement. So maybe you don't need to Roth convert or add to your Roth. So it's kind of situational, but the more you could put into the Roth IRA, I think the better it is.
I agree. We are, I'd probably say, we're big Roth people. We're always considering it in every financial plan that I feel like we're doing. I'd say if you're under 45, a lot of times it's almost a no-brainer to be considering a Roth contribution, even after age of 45. Up till a couple hours ago, I was talking to somebody who's in her 60s, and it might make sense for her to do a Roth conversion, just to have kind of both buckets growing. That way, once you retire, both buckets, meaning Roth buckets, after-tax money, and pre-tax money. That way, in retirement, when you're taking distributions out, you can kind of play the tax game a little bit to try to stay under certain tax brackets take a little bit out of the IRA, take a little bit out of the Roth. That way you kind of stay under that tax bracket.
So Roth's kind of newer to
Yep.
employer plans and really getting the hype up for Roth. So probably the past decade, it's been kind of growing traction. So there are some people that did not contribute to a Roth until they're at retirement, which is fine. It's okay. You can still contribute to a Roth if you have earned income. So that's the one caveat. You have to have earned income. If you retire and you only have pension or Social Security income, you cannot put into a Roth. But there is another way you can get some of your IRA money into a Roth. That's called a Roth conversion. So we actually help people all the time do that. And there's a couple reasons why we do that. Yes, you will have to pay the tax from it coming from the IRA to the Roth, which you got to be aware of and make sure you know and be conscious that you're not going to convert too much, that it's the right amount. Whether we've had a lot of clients. I had a client just last week. We were Roth converting up to the top of the 22%. And the reason why they were doing that, one, their beneficiaries, if they pass away, would have to pay taxes on their IRA inheritance. Converting to the Roth.
I'm going to jump in there too.
Ahead.
So the reason why that's important is because, once you pass away, your beneficiaries can start taking the money out. Normally, the age kind of lines up so when your beneficiaries at their highest earning years. So if they're already in the 22, 24% bracket and they inherit X amount of dollars and have to take it out and pay tax on it, could bump them up another bracket.
Mm-hmm.
So if you can pay tax in the 12% now, so your beneficiaries aren't paying 30% later, it's really, really a big benefit long term.
Mm-hmm. Yeah, so that's important. It really, if that's your goal to leave money to kids, Roth converting is probably one of the best strategies to reduce their taxes, if they get it. That's if that's what you want. Obviously, when you go into retirement, we say spend it how you want. You've earned it within means, but Roth is definitely a good way to move money from IRA to convert from IRA to Roth, because then it's tax free.
Yep. Another point to do a Roth conversion, another benefit of it is RMDs, so required minimum distributions. When you turn age 73, or they're actually about to bump it up to age 75 if you're born after 1960. That's when the IRS says, okay, you have not paid tax on any of this money yet. You're up. It's your turn to start paying some. So we make you take. It's around 4% a year when it starts. There's a formula.
Yeah.
But that's when they say, okay, you got to take it out. You got to take out 4% to pay tax on it. Sometimes, you might not need that money. The benefit with a Roth conversion, any money that's in a Roth IRA, you pay. There is no RMD requirement. So you are not required to take out any money, which is awesome. It could be a real big benefit if you don't need the money to live on.
Mm-hmm. Yeah, and that's where you can kind of control how you take money out. And Nate was saying you can have two buckets. One's tax deferred and one's after tax. So when you get into retirement, you can kind of choose which way you want to go and keep you under a certain tax bracket, so you don't have to pay too much taxes.
Yeah.
But it really just depends on what your objective is.
Definitely. And if you're still working, you're still on your younger side, I don't know, if you're still working in general, you don't have to do a Roth IRA. You can contribute to the Roth portion inside of your workplace, 401k, 403b in a lot of places. I'd say 80% of the plans you come across, 90% offer that as an option, would you say?
Yeah.
So you can do that inside of your own 401k. So, and that you don't have to change your deferrals to it. If you are adding more to it, just start doing a Roth. And that's kind of where we can come in and help and say, okay, do you want to change half of the amount you're putting in to go to the Roth and leave half of it traditional? There's a lot of flexibility inside the 401k.
Yeah, and like Nate said, that's kind of where we come in. We kind of take a holistic look at your financial plan and income, assets, where you want to be when you get in retirement. How is this going to affect you, and where am I going to get my income when I retire? So it's important to understand everything. I mean, you want to make sure that you've put enough into retirement. When do you take Social Security? That's when we kind of help out there too. Do we delay it to 70? Do we take it at 62? But it's important to look at everything, because you can't just look at one thing and that's it. You have to look at everything and make sure it all fits together. And that's, like we said, taxes. I mean, that's a big thing when you retire. You're going to pay taxes. Well, you're most likely going to pay taxes, depending on your income level. Not always. If you're in a Roth IRA, you will not pay taxes.
That's the whole point.
As well, there are a couple scenarios. There are Roth IRA. You do have a 5-year time clock where if you retire and you open up a Roth and you put money in there, your principal you can take out. You have to wait 5 years for the earned portion of the Roth to take out tax-free. So as long as you satisfied 59.5 and the 5-year rule, the Roth IRA is completely tax-free, no penalties or anything. But if you're under 59.5 and you have not kept the 5-year rule, their earnings will be penalized 10%, and you may be penalized by taxes as well. So
whatever you contribute or convert to a Roth, you can always get your hands on, so you don't have to worry about that. But like Brian said, if you're within that 5-year window and you try to take out your earnings, that's when you can run into some issues. The only other caveat I can think of a Roth, if there's another downside, if you want to call it that, would be the income limit to if you want to contribute to a Roth IRA. They're different for single filers versus married filing jointly, obviously. I don't know the numbers off the top of my head.
They change every year.
Yeah. But, that's something that we can dive into, too, as well with the financial plans.
Yeah. So, but in an employer plan, it does not matter about income levels.
Really good point.
You're able to put in, if your employer if you have a 401k and you're allowed to have Roth, it does not matter if you make $400,000, $500,000. You can put into the Roth as much as you want. There's no limitations. It's just the individual side where you have to be mindful. Because if you contribute to a Roth and you weren't aware, at the end of the year when you file your taxes, you will have to take that back out because the IRS will require you to pull it out because you've earned too much. So just be mindful with that, and don't blindly go in there and contribute if you make too much.
Yep. Really good point. So there's a lot more that we can jump into with the Roth IRAs, but we kind of wanted to keep it surface level for now. We'll definitely continue to build off of this. Investments, risk tolerance with Roth IRAs and Roth conversions is a big topic. We're probably going to do a whole episode.
Yeah, that's going to be a lot to go into because it really is just a lot to determine and kind of explain on the reasons why we think this.
Yep. And every situation is different, but we'll jump into a lot more Roth ideas and topics down the line. But we kind of wanted to just jump on here for the first one, kind of explain who we are, what we're going to be doing with the podcast. We don't have a set schedule on when we're releasing them. We're gonna try to ramp them up over this summer here and just try to get as much out as possible. So
if you're listening to this and you have a good topic you'd like us to get into, please comment or shoot us an email. We should have our emails attached to the end of this video. And if you just want to email us, hey, we think this would be a good topic to go over, we'd be glad to get into.
Yep, we have both of our emails obviously on our website, Nathan at cfsfinancial.com and Bryant at cfsfinancial.com. But I think the email that we're going to be using for the podcast, if you want to email us, directly for a podcast topic or, hey, you guys did an awesome job, we'd love to hear that, is retirement at cfsfinancial.com. So that's the kind of the one we're going to be using for the podcast. So if you have anything specific for it, feel free to use that one.
I agree.
Yeah, just wanted to jump on here, say hello, introduce yourselves, and we're excited for what's to come. Like Brian said, if there's any topics or anything you guys want us to jump into, feel free to shoot us an email or give us a call. So thanks for tuning in. We'll be back here hopefully in a couple of weeks with another one. So thanks again.
Till next time. Have a good one.